Hello and welcome to another edition of Inside the Vault. Once again, we're joined by Nick Beresheff, President and CEO of Bullion Management Group and author of $10,000 Gold, Why Gold's Inevitable Rise is the Investor's Safe Haven. Each week, we take questions from our BullionBuzz readers and answer them right here on Inside the Vault. This week's question comes from Todd in North Battleford, Saskatchewan. Todd writes, in an interview on CNBC's Trading Nation last week, two analysts were speaking about the gold price. One of the analysts, Craig Johnson, said that the price will move further down. He made a point to say that the average price of gold over the last 50 years has been just under $500, so there's more downside to be had. Nick, what are your thoughts on this analysis?
Well, I always find it amusing when supposed experts make comments like that without understanding any monetary history. There's really no point in talking about 50 years of average gold prices when the gold price was fixed up to 1971 as gold itself was money. It's just as ludicrous as I often see people make comparison of the equity markets to the gold price since, the 1700s. And, when the price of gold has been fixed throughout that period till 1971. And any stocks that were present in the 1700s are no longer even in existence. So what's the point of the comparison? So that's one of the major faults I find with these kind of analyst comments. The second one is that he said that the gold price has averaged $500 over the last 50 years. Well, the average price for the Dow over the last 50 years is 5,900. So neither instance does it mean that that's where the price is going to be just because it was an average over some pre-selected time frame. So that's a main issue with that comment.
Are there any other reasons why gold can't go down to $500 an ounce?
So the second reason why it's almost a ludicrous comment is that the cost of mining gold today, all in, is about $1,100, and many mines are having to high grade their deposits not to lose money, and many mines are losing money at current production cost. If gold was to somehow go to 500 because of more intervention and more manipulation that I talked about last week, then that would bankrupt most mining companies and there would be no supply. So with no supply, the price of gold would go through the roof.
So Nick, there have been some significant price movements lately. What do you make of that?
So in last week's video, I talked about the fact that there's significant interventions from time to time. And on Tuesday, there was a massive intervention of naked short selling on the COMEX paper markets of about 1.9 billion, which dropped the price from about 10.68 to reached a low of about 10.50. Well, on Friday, that completely reversed. So we went from 10.50 back up all the way to 1087 at that point. So you can see that the markets are taking huge swings back and forth. But what is indicated there is that the Friday increase in the gold price didn't simply happen in the US dollar. It was up 2% in every currency in the world. So that is an across the board. And what we've got to look at is eventually the fundamentals win out over the interventions in the paper markets. And that's when the price of gold will take a dramatic rise.
In the same interview on Trading Nation, analyst Andrew Berkeley said that for gold, you need signs of inflation, that it's got to be an inflation hedge. And he said that inflation expectations are not really moving higher, and the need to own gold is not really there.
Well, we've talked about that before, and there's a big difference whether you think that CPI is an accurate measure of inflation, which it isn't. If you go back to the old methodology of measuring inflation that you can see on John Williams' Shadow Stats site, it's about 8.5%. but most people aren't aware of that. But also, if you were to read anything about monetary history, Roy Jastum did an extensive study that showed that gold was actually better in a deflation than in inflation, simply because the purchasing power of gold increased more during a deflation than it did in an inflation. So that logic that gold is only worthwhile in an inflation is, again, simply wrong.
Thank you, Nick. Viewers, what do you think? We'd love to hear from you, so feel free to add your comments, or even better, get in touch with us at 1-888-474-1001, or visit BMG online at www.bmgbullion.com. Of course, you can submit your questions for Inside the Vault to info@bmgbullion.com. Thanks for watching.